Hey, welcome exampians. That is short for exam champions because that's exactly what you are and what you will be once you pass your life and health or health insurance exam. Today, I'm going to be covering some concept basics of the health insurance exam. So I hope this helps you pass your exam on the first try. If you're interested in a free study guide, just click the link in the description of the video. Okay, so first thing we're going to get into here is the basic concepts of health insurance, right? Basic concepts of health insurance. So health insurance covers two main perils: injury, which is something being hurt from an accident, and illness, when you're hurt from some sort of sickness, disease, virus, something like that. Okay, so it's also known as medical insurance, and it encompasses a wide range of plans designed to protect against the financial impacts of accidents, illnesses, and any resulting disability. The objective is to return the insured to the same financial state that existed before the loss occurred, adhering to the principle of indemnity. So indemnity is like you reimburse them so that they're in the same state as they were before the loss occurred. By the way, guys, I'm going to be going through these, and then I'm going to be giving you funny, easy ways to memorize a lot of these topics. Coverage is available through commercial insurers, self-funded programs, which is when people are self-insured, and prepayment models such as health maintenance organizations. We're going to learn about a lot of these in other videos, but this is the basics of it for now. So in addition to private insurance, many individuals obtain health coverage through public or government-sponsored programs, which are essential for financial protection. So there's private insurance, and there's also some public and government-sponsored programs like Medicare, Medicaid, military health care. I know Massachusetts has a program called Mass Health. So that's like a public-sponsored type, government-sponsored type healthcare program. If you don't live in Massachusetts, that doesn't matter, but that's just something, just gives you an idea. So health insurance broadly falls into three categories. So we have medical, surgical, and hospital expense insurance, okay? Disability income insurance, and accidental death and dismemberment insurance. So medical, surgical, and hospital expense covers costs related to medical services, surgeries, and hospital stays. So doctor visits, stuff like that, surgeries, hospital stays. Disability income insurance provides income replacement if the insured is unable to work due to illness or injury. Then accidental death and dismemberment insurance offers benefits in the event of death or severe injury caused by an accident. Okay. All right. So here's some creative and humorous ways to help you remember some of these basic concepts. So health insurance, perils. Okay, the two perils covered for health insurance are injury and illness. So here's a little comparison. You want to think of health insurance as like the referee between two twins, injury and illness. Injury likes to trip you up with accidents, while illness will sneak up when you're least expecting it with fevers and coughs and colds. Health insurance steps in with a whistle, breaking up the chaos by covering the financial mess left behind. So imagine if you trip, fall, you get hurt, you lose money, the insurance comes in and covers it. If you get sick, something happens, you lose money because you're sick, health insurance will come in and cover it. Or medical insurance is also what it's known as. Next, we'll talk about the principle of indemnity. So, okay. So imagine if health insurance was like a financial time machine. Okay, so I want you to look at health insurance as a financial time machine. You get sick or hurt, and suddenly your wallet feels lighter. But with the principal indemnity, the time machine kicks in, taking you back to where you were before the accident. No richer, but no poorer. It's like hitting the reset button on a video game, okay? So accident, injury, illness, something like that kicks in. For some reason, for whatever reason, you got to spend money on it. It costs money. And then the indemnity insurance kicks in, the health and medical insurance kicks in, and it takes you back to where you were before the accident. Okay, so I'm going to show you some mnemonic tricks. So I'm going to show you what the definition of that is. It's like a song, poem, rhyme, or outline with images and acronyms. So it gives meaning to something ordinary to make it memorable when you try to recall it. Okay, So this is a useful way for storing information in both your short and long-term memory. So this is called mnemonic techniques. So it's just fun, little, easy ways to remember things. So we're going to talk about the 3 categories of health insurance here. Okay. To remember the 3 categories: medical, disability, and accident, MDA, or MAD, MAD, you could say it is MAD. Health insurance is MAD. Medical, accidental, and disability. You want to think of them as the big 3 in a health insurance superhero team. Medical expense insurance is the healer. So this is the healer, which covers hospital stays, doctor's visits, and surgeries. So medical expense insurance is the healer, covers hospital stays, doctor visits, and surgeries. Disability insurance is the income protector, swoops in to keep your bank account steady when you can't work. And accidental death insurance is the accident avenger, offers a safety net for worst case scenarios. So we have MAD. If you want to, you can do these in reverse order. So medical, accidental, and disability. Medical is the healer. Okay, so it covers anything to do with healing at the hospital and getting the treatment you need. Accidental is the accident avenger. Okay, takes revenge, or it avenges those accidents by providing a safety net for worst case scenario. And then the disability income insurance is the income protector by providing income replacement. Okay. So medical expense insurance offers financial protection by reimbursing the insured either fully or partially for the cost of medical care. These policies are often referred to as reimbursement plans because they compensate the insured for covered expenses. The type of insurance includes a variety of plans that help manage expenses related to hospital services, which covers inpatient stays, treatments, and services provided by hospitals. So anything that happens at the hospital. Surgical costs, which is anything related to costs for surgery. Physician costs, which is doctor's visits and services provided by a physician. And medical treatment programs, which is specialized treatments like physical therapy, rehab, and stuff like that. And then outpatient care, like consultations, diagnostic tests, and treatments that do not require hospitalizations. Okay. Medicare supplement and long-term care insurance. These are designed for older adults, but these are categorized as types of medical expense insurance as well. Okay, so medical expense insurance, for a little memory hook here, imagine health insurance as a big restaurant buffet. You get a menu of services like hospital stays, surgeries, doctor's visits, and outpatient care. So if the hospital stays is the main course, these are the side dishes, the surgical visits. The doctor's visits are the snacks, and the outpatient care and medical treatment plans are the dessert. This makes sure you don't have to foot the entire bill when you load your plate up. All right, so it's like you get an insurance and you can have a buffet of all these things for the same amount. Okay, you pay a certain amount for insurance and then you just have access to these types of treatment. Right? Okay, disability income insurance. This is a general. I have a whole big chapter on disability income insurance, but this is just in general. All right. So disability income insurance, sometimes called loss of time insurance or loss of income insurance or an income replacement policy, is intended to provide a steady source of income when the insured is unable to work due to a disability. This type of insurance does not pay for medical expenses related to the disability. Instead, its purpose is to ensure the insured receives a regular income during the period they're unable to earn wages. So payments are typically made on a weekly or monthly basis and are designed to maintain financial stability throughout the duration of the disability. So disability income insurance is like having a magic wallet that never empties. If you're unable to work because of any injury or illness, the insurance keeps refilling your wallet with weekly or monthly payments, so you don't have to worry about going broke while recovering. There's a lot more to disability income insurance. I have a whole another video on it, but this is just a broad generalization for this video. Okay. Accidental death and dismemberment insurance. Accidental death and dismemberment insurance, also often known as AD&D, is a straightforward form of accident insurance. It provides a lump sum benefit to the insured in cases of accidental death, meaning you die as a result of an accident, or dismemberment, like losing an arm or limb or vision, something like that, due to unforeseen circumstances. So common usage is generally included in group insurance plans, right? And then there's a bunch of other things that you can do with accidental death and dismemberment insurance. So imagine you're playing the game of life and you get hit by a surprise car. Like, oh, here, you lost an arm. No worries, AD&D insurance kicks in like the game's emergency fund, giving you a lump sum to cover the financial fallout. So essentially it's intended to be like, hey, well, what is the cost to you losing a limb or having an accident happen or something like that, and it will cover that. Don't get confused with car accident. Okay, like some of these things could happen in a car accident, but this isn't like accident, like it'll cover your car. This is on the individuals. This is health insurance or sickness or accident insurance. Okay, within each of these three categories, medical expense or health insurance, disability income insurance, and accidental death, there are various forms and adaptations of coverage that have emerged to cater to distinct insurance requirements. Okay, so the impact of providers. So the type of health insurance provider can influence the structure and offering of these coverage types. So there's different types of providers that you'll learn about in some other videos, but that it can influence the structure and offering of the coverage types. Each basic coverage type in the various health insurance providers will be explored in detail later on in other parts and other chapters, other videos. So this aims to familiarize you with the overall landscape of health insurance, okay? All right, so here we go. So a little fun rhyme here. Want health insurance just for you? Fill out forms and maybe they'll approve. Choose the perks that fit your need and pay the premium. Good health's your seed. Kind of corny, but okay. Health insurance policies, they're provided by commercial insurance companies, so typically private organizations, but they're also provided by service organizations. So the coverage specified in the policy becomes active on the policy's effective date. So although health insurers provide standard policies, many give individuals the flexibility to select different options or benefit levels that align more closely with their particular requirements. Similar to life insurance, health insurance can be obtained by individuals and families through either individual policies or group plans. So there are different ways to purchase health insurance. We're going to get into the different ways to purchase it right here. So essentially, there are insurance companies that provide health insurance. You can get an individual policy or a group policy, and there's usually different plans and packages that you can elect to receive. And it may vary in what someone's deductible is, or their co-insurance percentage, and their max out of pocket, or the maximum coverage limit, stuff like that. So there's different plans. It's not like there's always just like one plan to choose from. There's usually a bunch of options. So individual health insurance is a direct agreement made between the insured and the insurer. So it's like it's you and the insurance company. That's it. You and the insurance company. Requires an application and may involve providing evidence of insurability. Okay? Application and may involve evidence of insurability. Evidence of insurability means you're showing them that you are insurable. Insurers offer different benefit levels or options to meet specific individual needs. So I'll give you an example of what this is like and kind of how it might look on the marketplace. So say you have John, kind of looks like an ant, but whatever. John, so he goes out and he wants to buy an individual health insurance policy. Okay, individual. Now, he goes to the company, and we have an XYZ company, a health insurance company there. So, health insurance company, cool. So what he does is he has to provide evidence of insurability through an application and different health checks that they do. Okay, so he applies. If he's getting an individual policy, he applies, and they may or may not have to provide evidence of insurability. Sometimes, depending on the policy, he might. Other times, he won't. So a lot of them through the marketplace, like healthcare.gov, are not, they're guaranteed issues. So it doesn't matter like what the pre-existing are. So he provides his insurance. Say he does have to apply it here, or apply for with evidence of insurability. Health insurance company says, you are good to go. He gets the green check. He's healthy. And what they say is we have option 1, option 2, option 3, and option 4. This is just an example to give you guys an idea. Okay. Well, let's say option 1. It has, say option 1, there is, $200 copay, $5,000 deductible, and then yada yada yada, the other coverage amounts. Okay, that's one example. Option 2 might have a $100 copay with a $3,000 deductible. This premium, since he has to pay more at the copay, so this premium might be lower than this premium monthly. So say this one is $100 a month, and this one is $150 a month. So essentially what it's saying is that the copay is how much you have to pay every time you go to a visit. So this might say, okay, you can pay $100 a month, but every time you go to the doctor, you're going to have to pay $200 out of your pocket. We'll cover the rest as long as the deductible is met, which we'll get into that another time. But this one's saying, hey, well, if you pay $150 a month, then you only have to pay $100 for your copay. So and then it'll just go, on and on with the different options. Now, that's not like how they all are. So I don't want you guys to think that this is every health insurance plan is going to be this much a month with that copay deductible. That's not the case. These are just examples to give you guys an idea. John applies for health insurance. They say, cool, you can get health insurance with us. And then they're going to give them some options. And then John says, oh, well, I want this one or whatever, right? Say he says, well, I barely ever go to the doctor, so give me the cheapest one, whatever the case is. Okay. And option 4 could be 0 copay, 0 deductible, $350 a month. But if John goes to the hospital all the time and has a ton of doctor's visits and stuff, then that one might be the best option for him. So the health insurance company will give John a bunch of different options. Okay, hope that helps. Okay, short-term policies. These are called short-term medical plans. They provide temporary coverage for situations like being between jobs or waiting for a new policy to take effect. They're also known as interim coverage, short-term medical insurance, term policies, or period of time policies. They're not renewable, so if coverage is needed after the policy expires, a new application is required. All right. It's called short-term medical plans. They used to be popular, they're not as popular anymore. So short-term policies, they're like trial memberships at a gym. You only use it for a little while, but once the time's up, you got to apply for a new one. So group health insurance. Group health insurance covers a group of individuals, such as employees or members of an organization, under one contract. Okay, so these can be offered to organizations such as labor unions, credit unions, employers, and trade or professional associations. These plans may also cover blanket and franchise policies. You'll learn more about those blanket and franchise policies. So we'll just franchise health policy. Yeah. Okay, we'll learn about those after. So there's a master contract. It's an agreement between the insurer and the group, such as an employer. This contract provides coverage to the group members. Although it provides coverage to the group members, those members are not direct parties to the agreement. So when there's group health coverage, the group, which is the employer or organization, owns the policy and they select the coverage options. The group pays the premium, but members can be required to contribute through paycheck deductions. Typically, there's lower premiums due to reduced administrative costs. Group policies generally have lower premiums than individual policies, right? Because it's one group master policy, and then everybody involved can be in it, everybody in the group. Group members fill out an enrollment form, but do not need individual underwriting or evidence of insurability. So in the individual health plan, sometimes you have to provide evidence of insurability, fill out individual applications for underwriting. But with group plans, there's just an enrollment form, and they're guaranteed to get it. Group policies typically are more flexible and have more liberal coverage compared to fully underwritten policies. Okay. All right. So group health insurance, it's like being on a team subscription to a streaming service. Okay, your employer, the team captain, buys a big plan for everybody, so you get access to coverage at a lower price. You might have to chip in, but the group plan saves you from paying full price. So it's kind of like, if you get if you had a family plan for a cell phone, right? So just your bill alone, say for the cell phone, this is at the health insurance too. Say your bill alone for the cell phone would be $120 a month. Okay, but if you get a family plan, you might be able to get unlimited coverage for 4 people for $240 a month. So that means each person pays $60. Okay. So the group plan is the same. The group health works that way. It's like, hey, that everybody contributes, and it's a bigger group of individuals. It helps with adverse selection because they say, well, if everybody's covered, we're going to get some people who file a lot of claims, and we're going to get some people who just don't file any claims at all. Okay. So government health insurance programs. So health insurance is also made available through programs run by both state and federal governments, right? There's state programs like Medicaid. Medicaid offers coverage to those with limited assets or income, including those receiving welfare, individuals who are blind, aged, disabled, or under 21, right? So, and then there's Medicare, which is a federal program. So state-run plan is Medicaid. This is for people either who have very, very low assets or income, like people who receive welfare, or people who are blind, aged, disabled, or under 21. Now, Medicare is a federal health insurance program primarily for people over 65 or with certain disabilities. It's the OASDI disability provision. So it's old age survivor disability income, or disability insurance, sorry. Part of the Social Security system, it provides health coverage for disabled individuals. So Medicare can also provide coverage for disabled people. So it's 65 or older or disabled, certain disabled. Okay. So you want to think Medicare and Medicaid, they're like the two superheroes in the health insurance world. Medicaid, you want to think of it as Medikid, or Medikid, I guess, the hero helping those with limited resources, such as the elderly, blind, disabled, and under 21. Medicare is the Medisenior, the superhero with a focus on saving the day for people over 65 or with those with disabilities. Okay, so Medicaid, you want to remember it's state-run, and it's for people who are very low income, on welfare, blind, aged, disabled, or under 21. Now, aged, if they're over 65, typically they're going to receive Medicare, which is a federal plan. All right. Okay. So a proper health insurance program. So determining what constitutes proper depends on several factors, right? So there's the type of coverage. So is this for a person, a family, or a business? There's existing coverages. So is there access to any group plans or social insurance already in place? And then the willingness to share costs. So how much is the policyholder willing to take responsibility for medical expenses through deductibles and co-insurance in exchange for lower premiums? That's like the example I gave before, right? The lower deductible and co-insurance, the higher the premiums typically are. So these and similar questions must be considered before identifying the most appropriate health insurance program for a person or entity. Okay, so it's like It's like picking the best pizza for a party. You got to ask, hey, who's at the party? Is it for an individual, family, or business? What are the toppings? Right, the toppings. So is there already any other plans there? And then how much are people willing to pay? So how much are you willing to pay for pizza? Individual needs for health insurance. In the past, it was common for families to provide support during illness or disability, but it's no longer feasible for most, right? It's very expensive. So individuals are expected to take responsibility for the medical expenses. Unless a person is independently wealthy, paying for healthcare out of pocket, it's usually not a desirable or even a possible option because of how expensive it is, right? Like a hospital stay, it's crazy money. So it's like not even feasible. So losing your health, having poor health is very, very expensive. Price of medical care is extremely burdensome, and also that individual usually loses income. So disabling illness or injury often leads to lost wages, compounding the financial strain. Right? Most families now rely on the income of both parents, so it's essential to account for income needs of both when creating a health insurance plan. So if someone gets sick or has their health deteriorates, not only does it cost more money, but they usually lose income from not being able to work as much from being sick. So, characteristics of health insurance. While health insurance serves as a similar purpose to life insurance, there are key differences between the two. Understanding the distinctive features of health insurance lays the groundwork for more detailed discussions later on in other parts that I'll be covering. So, unlike life insurance, which is generally permanent, like whole life insurance, permanent, right, not term, health insurance does not guarantee long-term coverage. So, life insurance policies will remain in force as long as premiums are paid. And even term life policies remain effective for the entire term if premiums are up to date. But health insurance policies can vary widely in terms of their renewability provisions, which specify the insurer's ability to cancel the policy at different stages throughout its term. So I've had many health insurance policies myself where the insurance company just all of a sudden says, yeah, we're not renewing your policy next year. We're not providing that policy anymore, or we're not in your state or something like that. So the insurance company can just decide, we don't want to offer that program anymore. We're not going to allow them to review, or we're not going to allow you to renew the plan. Okay. So you want to think of it, health insurance is like a gym membership, and then life insurance is like the VIP access pass that never expires. So health insurance, it's like the yearly gym membership. Okay. The gym can change the price and whatever they want with it. Life insurance, it's like, hey, I'm paying. That's that VIP pass. Like I can get to the gym no matter what. I'm just going to pay the same. Health insurance is like the monthly or annual subscription that they can change. Right. So these are some renewability classifications for health insurance. Cancelable. The insurance company can cancel the policy at any time. So it's like a streaming service that can cut you off at any time with a quick email. That's it. Optionally renewable. The insurer may choose not to renew at the end of the policy period. So optionally renewable, the insurance company may say, well, we may not, like I was talking about before, we may renew, we may not. It's up to us. Conditionally renewable. So they have the option to renew. Conditionally renewable means it can be renewed unless specific conditions are met. So it says, hey, it's renewable as long as you're not X amount of years old, or as long as like certain event hasn't transpired. So it's based on a condition. And then guaranteed renewable, the policyholder has the right to renew the policy. The insurer can't cancel it, although premiums may increase. And non-cancelable is the insurance company cannot cancel or raise premiums provided the policyholder continues to pay. Okay? So non-cancelable is the best. You keep your plan, they can't raise the price, like lifetime subscription forever that can't be canceled. Guaranteed renewable is, hey, you can keep it. This is like Netflix, right? You pay every month, but hey, you know how frequently they raise that price. Conditionally renewable, it's like being in a club that kicks you out when you hit a certain age. Okay? It's like, well, once you can only be in Cub Scouts for so long. After you hit a certain age, you're in Boy Scouts or whatever they call it now, Scouts. Optionally renewable, they can decide whether they want to keep you there or not. It's like the cool crowd. And cancelable, they can cancel at any time. Okay. So in general, the more favorable the renewability provisions for the insured, the higher the policy cost. So if it's only based on these factors, this one would be the one that costs the most because it's in the best interest of the insured for renewability options, and this one would cost the least. And then individual blanket family hospitalization policies, except those covering fewer than 10 people, must be renewable at the policyholder's option unless the insurer gives at least 30 days notice of non-renewal in writing. Okay. So saying it's renewable, but they can, unless they give you a 30 days notice that it's not renewing, which is what a lot of companies would do anyway, to let you know. Okay. All right. So let's see if there's anything we can think of there. All right. Okay, premium factors. So what factors into the premium costs? Well, health insurance, like life insurance, is financed through the routine payment of premiums. However, there are fewer payment options for health insurance policies compared to life insurance. So, for instance, health insurance plans do not provide options like a limited pay plan, such as a 20-year pay or single premium pay, where you have it for the rest of your life or paid up at retirement, which are common in life insurance policies. Health insurance premiums are paid year by year. Mostly people pay it month to month, except for non-cancelable policies. These ones may experience rate increases. Health insurance premiums can be paid annually, semi-annually, quarterly, or monthly. So once a month, once every 3 months, once every 6 months, or once a year. Monthly premiums are frequently paid using a pre-authorized payment method, allowing the insurer to automatically withdraw the premium directly from the policyholder's bank account. All right. So health insurance is paid annually, semi-annually, quarterly, or monthly. And unless the policy is non-cancelable, then annual rate increases or changes may happen. Okay. So there's some factors that influence the calculation of health insurance premiums, like interest, expenses, types of benefits, and morbidity. So interest is the insurer's expected return on investment premiums. The expenses are the operational and administrative costs incurred by the insurer. Types of benefits, this is the nature and the extent of the coverage provided, so like how much coverage is there. In morbidity, this refers to the anticipated rate of illness or disability within an age group over a certain period of time. It's like mortality in life insurance, so it's like the odds of someone getting sick. Okay? So I'm going to pull up this here, and then I'm going to give you a quick example of, which was over here. Oh, how the basics of how the health insurance works, okay? So we have everybody here paying in. So we have everybody who's paying into the policy, and they pay their premiums every month, all right? These are all people, believe it or not. So they're paying their premiums every month to the insurance company, and all the money goes into this pot here, okay? So the interest, so the expected return on these premiums that the insurance company, so this is the insurance company, IC, insurance company. They take this money and they invest a lot of it for a return. That's how they make a profit. So how much they charge for premiums is based on, hey, how much do they think we can get back? So if they think there's a high return on the investment, that would lower the premiums, right? Because that means the insurance company makes more money. Expenses, so this is what are the operational and administrative costs. So, say, well, how much do they have to pay their employees and all that other stuff, right? So say there's a mandate that this company has to pay, or say this company all of a sudden gives everyone a raise, right? They give all their employees a raise, then that might increase the premiums. And the types of benefits. So how much coverage are they getting? What type of coverage is it? How much of a risk is the insurance company taking? And then morbidity, like what are the chances of these people actually getting sick and having something happen? So that's what determines the price of these premiums right here. Okay? Other factors include claims experience. So it could include this. So it could include the insurer's history of paying claims, age. So older individuals typically face higher premiums. Some premium rates may vary based on gender. A lot of them don't. And occupation. So riskier occupations can sometimes result in higher premiums. Depends where the policy's bought, though. Okay. A lot of times the government marketplace programs, it'll increase with age. Gender, I believe, pays the same, and occupation, they don't take that into account. Okay. So next we have participating versus non-participating policies. So health insurance companies may be offered as either participating or non-participating, but most individual health insurance, it's typically non-participating. So most of these are non-participating. So these are group participating plans are policies that participate in dividends or utilize experience ratings. So mutual insurance companies offer group health policies for dividend and provide dividends. Stock companies issue experience rated plans, which adjust premiums based on the claims experience of the group. So the most common one is stock companies. So what this means is premium reductions may be applied retroactively for 12 months, but premium increases are never applied retroactively. So for instance, like this is based on where premiums are adjusted based on how many people file claims, essentially. Okay, so that's where it says experience rated group policies. All right. Okay. So premium reductions may be applied retroactively for up to 12 months. So they could, reduce the premium and maybe give some money back, where refunds from experience related policies may depend on the renewal of the master policy, while the payment of dividends is typically not conditioned on renewal. So the dividends are not guaranteed. Okay. And then premium increases obviously can't be applied retroactively. So let's say they're like, oh, you know what? There were less claims this year, so we're actually giving you some money back. They can do that, but they can't be like, oh, there were more claims this year, so we need you to pay more for what you already paid. So they just have to increase rates in the future. So if there's a premium reduction, they can say, hey, you actually overpaid this year. We didn't have a lot of claims filed. We're going to give you some money back, but they can't retroactively go back and take money, if that makes sense. Okay. And there's some factors that influence dividends and refunds. Dividends are very uncommon in health insurance, but cost accounting methods are intricate and differ between insurance companies. So the two primary factors that determine whether a group policyholder will receive a dividend or an experience rated refund, we talked about it here, are expenses. So what were the operational and administrative costs incurred by the insurer? And then the claims cost, the cost of claims paid out by the insurer. So if these were higher, then typically the person will have to pay more premiums next year when they renew. That's part of the policy provision where if it's not a non-cancelable policy, remember the ones we talked about up here. I know it's up there somewhere. You guys can rewind if you need to find it. In claims costs, so how much do they have to pay out in claims? So if these cost factors are lower than projected, the group policyholder gains by receiving a dividend or a refund credit. However, if expenses in claims are higher than expected, the group policyholder may not be eligible for dividend or refund credit. Okay, so remember, mutual companies will pay dividend. A stock company will have the refund credit. Okay. Very rarely are they going to give you the money back, though. I'll tell you that much. Okay, next we're going into cost sharing. All right, so it's out-of-pocket cost. So cost sharing, what this does is this refers to the portion of healthcare costs that you have to pay out of your own pocket for services covered by your health plan. Common types of cost sharing are co-payments, This is a fixed amount paid for a covered service, typically at the time of service. Deductibles is the amount you must pay before your health plan begins to cover its share of costs. Then coinsurance is a percentage of costs you share with your insurer after your deductible has been met. Okay? So coinsurance and copays is what you pay. Deductibles is what you have to pay before your benefits kick in. And then out-of-pocket max caps your claim. So it's important to note that cost sharing generally does not include expenses such as premiums. So the regular payments you make to maintain your insurance is not involved in cost sharing. You pay, and then you have to split the cost. So you pay, and then you got to pay some more. Or penalties, additional fees or charges you may incur, or costs for care that's not covered by the plan. Now, there's also an out-of-pocket maximum. So the out-of-pocket maximum is the total amount an insured individual must pay for covered services in a planned year. After reaching this limit, through spending on deductibles, copayments, and coinsurance, the health plan will cover 100% of the remaining costs for covered services. So the out-of-pocket, I might have misspoke earlier. The out-of-pocket maximum is the maximum that you will spend out-of-pocket between deductibles, copayments, and insurance. The health plan will cover 100% of the remaining costs. Okay. The out-of-pocket maximum does not include monthly payments, so you still have to keep your recurring payments. And it does not cover for costs for services not covered by the health plan. So this is only for services covered by the health plan. All right. So we're going to look here. Say we pay every month. Okay. So we got us, little agent here. Yay! I love insurance. Okay. So you have your policy, and you pay your premium. Okay. Pay your premium. Then you have your copay. So you pay your premium every month, and then when you go to the doctor's office, you usually have to pay a certain amount. A lot of times, policies will allow for one routine visit per year to be covered, but most of the time, other appointments you have to pay a copay. So it's like $20, $50, $100, whatever the case is. Specialists may cost more money, stuff like that. But anyways, the copay is how much you have to pay when you go to the visit, and then the deductible is how much you have to pay for a service before the insurance kicks in. So say you get hospitalized and you need to have, say you get hospitalized and you have something going on with your, I don't know, lungs or something, right? You have to have lung surgery. Well, if your deductible is $5,000, then you have to pay the first $5,000 of the cost. So the deductible is the amount that you have to pay out of pocket before the insurance kicks in. And then the coinsurance is the percentage you have to pay after. And then there's the max out of pocket. So I'll show you how this works. So you pay your premium every month, no matter what. You go to the doctor, it's a $100 copay. Okay? He says, wow, you need surgery right now. The surgery is going to cost $50,000. But your deductible is $5,000. Okay? You cover the first $5,000 of that surgery. Coinsurance is, say you have to pay a 20% coinsurance. So we go 20% coinsurance. Okay, 20% coinsurance, and the max out of pocket, say, is $10,000. So $10K. So what this means is you've already paid $5,000 for your deductible and $100 for the copay, right? Because I believe it doesn't count max out of pocket. Doesn't, yeah, okay. So you pay your premium no matter what. So you have to keep paying this always. Okay, always. Okay, you pay your $100 a month copay. Your deductible is $5,000. So say that the surgery itself is $50K. Okay. Hey, you got to go to surgery right now. It's $50,000. Okay. So you paid $5,000. All right. So that leaves $45,000 left that has to be covered, right? You take the $50K minus the $5K, so $45,000 still has to be covered. So you pay your deductible. Now the insurance company is going to help cover some of the cost, but you're at a 20% coinsurance, right? So you have to pay 20% of the cost until the maximum that you've spent between your deductible and your coinsurance is $10,000 with this max out of pocket. Okay, so I'm going to erase this here. It's super ugly. So what this would mean, and I know I might be losing you here, but this is going to help. So you need to spend, you spend 20% of the cost until you spend an extra, whatever amount extra it takes to have the total amount between your copay, your deductible, and your max out of pocket to be 10K. Okay, so it's just about another $5,000. So if you spend an extra 25, so 20, the first, so say this, the first, say 25K, another 25K is covered, right? You pay coinsurance on this, the 20% coinsurance you pay on this, because 20% of $25,000 is $5,000. So you're going to say, which is about what you need to max out your max out of pocket. So after that, the additional 20K is completely covered by the insurance company. So I'll run through that again. You pay your copay to go to the doctor. He says, yep, you need insurance right now. I mean, you need surgery right now. The surgery is going to cost $50,000. You have to pay your deductible first before insurance kicks in at all. So you'll get billed $5,000 to cover your deductible. That leaves $45,000 left over to cover the surgery. Okay. Your max out of pocket is $10,000. So you pay a 20% coinsurance on the cost, which is you cover 20% of the cost of the procedure until you've spent a total maximum out of everything aside from your premium. So the copay, deductible, and coinsurance out of $10,000. So it's about 25K here. It would be a little less, right? But I'm using a round number. So say your copay was $0. That would be a true, say the copay was 0 in this case. That'd be a true, okay, 5,000 here. So it's 45K. And then the next 25,000, 20% of 25,000 is the additional 5,000 that you would need to get this total max out of pocket to 10K. So then after that, you've spent your total max out of pocket of 10,000, and the insurance company covers the additional 20,000 in full. So that's basically how it works, right? Okay, claims. The responsibilities of a health insurance claims examiner differ somewhat from those of a life insurance claims examiner due to the complexity of health insurance claims, right? So life insurance is pretty easy. Did they die or not? And did they fall what's the coverage amount? Is the insured dead? But health insurance, there's more involved. So there's medical expense insurance that operates on a reimbursement basis. So this means the amount paid is not predetermined, but based on the actual loss incurred. So life insurance is predetermined how much it's going to pay out. But health insurance, it depends on how much the loss was. The insured is reimbursed for covered medical expenses up to the policy limits. Now, these reimbursements are generally exempt from income taxes. They're not meant to restore the insured to the financial position they had before the loss. Okay, valued contracts are like life insurance, AD&D, and disability income insurance. These are different. These pay a fixed amount defined in the policy when a specific event like death or disability happens. Medical expenses, whatever, it depends on what you had the treatment for, right? So they must verify whether a loss has occurred. This is particularly difficult in disability income cases where determining whether the insured is truly disabled can be subjective and lead to potential misunderstanding. So finally, the assignment of benefits directly to healthcare providers makes the claims process more convenient for the insured as it simplifies the handling of accident and health insurance claims. So there's assignment of benefits. So assignment of benefits is when they just, essentially when they collect when they pay it directly to the insurance carrier, right? Rather than having to worry about the whole reimbursement thing. Okay. So again, a couple other basics here. Let me see. Yeah. So that's all I'm going to cover for that video. Hope this helps. Hope this helps you guys study your pre-license material. Keep tuned for the next video that I'm going to be putting out for health insurance basics. And I hope this helps you guys. Subscribe to the channel, turn on post notifications. Click the link in the description of the video for a free study guide as well. And if you'd like to potentially work with me, just email me at the email in the description of the video. There's also a link you can fill out to apply to work selling insurance with me at my agency. So thank you very much, everybody.